to be in partnership with the CME today and give you a presentation by David Gibbs. David here is over 40 years experience in trading. He started out in the open outcry pits in Chicago. He's the Director of Education for the CME. We're very pleased to have him here today to give us an explanation about how to create a trading plan. A seminar I should have probably attended 20 years ago, but here we are. David will probably be speaking for about 45 minutes to an hour. We would quite like this to be a bit more of an interactive seminar, so if there is any questions that you have as we're going along, please don't hesitate to shout out or put up your hand or something, and David would be pleased to explain that point for you if you have any questions. Afterwards, we will still be having some refreshments outside, so it would be great for you to kind of stick around and catch up and say hi. So, without further ado, we'll take that. All right, I'll introduce you to David. Thank you very much.
Thank you very much, Mark. Thanks for coming, everyone. Welcome. I'm David Gibbs. I'm with the CME Group. I'm based in Chicago, which is our corporate and international headquarters. But I also have some colleagues with me from our London office, Sharif Jugman, who represents and runs our business focused in this region, and Antoine Vassal, who is a colleague of mine on the education team, who helps organize our educational activities in the region as well. Thank you to our friends at APM for hosting us today. As Mark mentioned, we're going to be talking about things that might be useful in developing your own trading plan. None of this is meant to be rigid or firm. I would suggest that you always think about doing your own homework, developing your own plan, because you're going to be accountable for the results. So take responsibility for your learning and take responsibility for the results of your trading. I have to begin by stating our time together is meant to be educational and informative, and is in no way meant to be construed as my offering investment advice, nor making any trading recommendations. What you're going to be seeing in the short presentation I put together are examples of screenshots from our website, and then I'm going to actually toggle over to the internet version of the website, and we can move around and explore these things in real time to show you how deep that toolbox can be, depending on your interests, products, and acumen as far as where you are in your development plan. So, as Mark mentioned, part of the information transfer should be communicative. So feel free to ask questions, raise questions or thoughts, because we want this to be more of a conversation rather than a lecture. So I'm going to begin by reminding or introducing to some of you that may not know CME Group. We're the largest derivatives futures exchange in the world. We have a broad array of benchmark products across basically 6 asset classes. Our oldest is in the agricultural space, and this includes grains, livestock, oil seeds, even things like fertilizer and dairy products. We have an industrial commodity business in crude and refined oil products, as well as natural gas. We have a metals business, both base and precious, gold, silver, platinum, palladium, as well as copper and aluminum being the leading products there. In the financial area, our oldest franchise is in the foreign exchange area, trading of currency pairs. And that's also backed up by a very large interest rate business, predominantly US dollar based, and then an equity index business, taking in mostly the large US dollar benchmark equity indices, but also some non-dollar indices as well. And that includes our cryptocurrency index business, of which we have 2 leading cryptocurrency futures contracts, and even some esoteric products like real estate indices and futures contracts based on weather. So where we have traditionally done our business is in the institutional commercial sphere, for people who come to CME that already have inherent business risk that want to sell it. And in order for somebody to sell risk, somebody else has to buy it. And it's our function as an exchange operator to develop a platform that encourages as many individual interests as possible to gather around our products which aids us in our two main purposes. One is price discovery. The greater the competition and the competition for price, the greater the intelligence that can be derived from those inputs to arrive at price discovery. The second is equally as important, which is this transference of risk from people who want to sell risk to people who are willing to buy it. Sometimes those buyers are hedgers. Most of the sellers are trying to lay off risk, but there's an important other participant in our marketplace, which is known as the speculator. People who bring new capital to our marketplace with anticipation of profiting from their trades. That's what a self-directed retail trader brings to our environment. And it's this balance between hedging and speculation that we try to bring to the marketplace in the form of liquid, transparent, standardized futures products that are the same for everyone in an open exchange environment with a central limit order book. All of our business now is done exclusively, well, almost exclusively on our Globex electronic execution platform that you can see if you've got an internet connection 23 hours a day. The CME Marketplace opens every afternoon, early evening in Chicago at 5 p.m. So today's session has been open for several hours already and will stay open until 4 p.m. Chicago time when we shut down for 1 hour so our technical system can refresh for that day. Everybody gets the same settlement value on all of our products, and those settlement values are determined by that contract specifications. Boy, now we're really in the dark. Anyway, this is a screenshot of our website. And for those of you that have been to our website, this will be familiar to you. You've got things running across the top: markets, data, services, insights, education. All of those can be clicked on, which provide you, takes you to a different landing page. The markets page will offer to take you to different product asset classes that we've talked about, those various products, whether it be energy or interest rates or equity index products. Data might be important to some of you as we start to talk about particularly our options business, about where to get maybe some more technical information that's released through our data portals. It also is where a lot of our operational people go to for information. Services would include things like if you're ever involved from an operations side in a delivery, that's where you can get access to what's being delivered and when it's being delivered and the timescales and all those things. But if you click on the Education tab, you will go to this landing page. And from there you can go a lot of different ways. You can see all the different choices that you've got here in terms of economic research and commentary and analysis if you're interested in exploring that on your own. There is a trading simulator that is available so that you can begin to explore. I believe it's on a delayed market feed. It's not live market feed. There are other things that are available on there, including several of what we call trading challenges that are open to the public, where you engage in a competitive environment using a trading simulator to actually simulate real life trading. On the far left, you've got all kinds of things that you can do, including courses and lessons that are available on the website. But another piece of information that's under events and webinars is an economic releases calendar. And I would suggest this is a key component of any trading plan because you need to know what economic releases are coming out on any given day that can influence the price action of either a commodity or a financial product. All of these are laid out in an outsource we get from Econoday, which not only publishes the calendar, but when an economic release has been made, there's actually the report is published on this website that you can read. This last week's CPI release on Tuesday was a major market event that changed both interest rates in the US as well as influenced the pricing behavior of both the US stock market but also the foreign exchange world. But on any given day, there's a whole host of economic releases, and depending on the products you're trading, knowing when those economic releases are occurring is vital to either being out of the way if you want to avoid adverse price movements, or how to set up and be prepared for what could be the result of maybe an adverse announcement or a price release. So I use this myself every day to get set up to know what's coming or what's been released in Asian or early European time zones that I have slept through when I get up in the morning to get set up for the US Open time period. If you go back to the website and you go under the markets page and you select one of those product asset classes, I'm just using E-mini S&P as an example here. So under equities, you're going to see all of the index futures contracts that are available. By clicking on, in this example, the E-mini S&Ps, you'll go to its product page. From there you can see, again, much more additional information. The last price that's traded on the December contract is shown here. Its change in index points as a percentage and the volume that's traded. But you might want to dig a little bit deeper into that information, and that's what's available down here. Quotes, and it's usually a 10-minute delay on the website. You can look at previous day's settlements. You can look at volume and open interest, and this is one we're going to look at because these are key pieces of information. Time and sales would only be relevant if you were looking backwards and wanted to see where certain prices transacted. This is important because it's the contract specifications. And as you're getting familiar with our products, you're going to want to know the details of what makes that contract work. The specifications outline the responsibilities of the buyer and the seller, because this is a legal contract. A futures contract is exactly what it says it is. So knowing what those specifications outline, the unit size of the contract, the minimum price increment change, the hours in which it changes, is it a cash settled future or a physically settled future? What's the settlement procedure? All those things are included in the contract specs. Margins is that important number that tells you how much you have to put up for each contract. Or maybe more importantly, how much the clearing firm has to put up on your behalf. Now I would say we hold our clearing firms responsible for their customer behavior. You as individuals cannot open an account with CME. CME does not have business relationships directly with end users. We have relationships directly with our clearing firms. And the clearing firms are whom these margins are set. Those clearing firms are responsible for your financial security for the next 24 hours. But we're marking them to market twice a day. So they have every right, in fact you might say a fiduciary responsibility, in many cases to ask for margin, that's the performance bond or the capital you have to post, over and above what we're asking of them, because we're holding them accountable for your 24-hour risk on a 12-hour basis. So don't be surprised if the margins that your broker's asking for are slightly higher than what you see on the website. And then the calendar is also important. This shows you the last trading days and the expiration days of the futures. And for those of you that are interested in the options that we trade at CME, there are options on the futures. And as you'll see in a minute, you toggle from futures to options, you'll see the options expiration calendars as well. So in a quick view, you can see there's a lot of information contained here. If you click on the quotations function on that previous slide, you have the ability to create, under the little charting icon, to look at a price chart. And you can add, if you like to use technical analysis tools, on the left toolbar, all kinds of things like trend lines. What you don't see at the top, there's an additional toolbox where you can have overlays like moving averages. This is a relative strength index at the bottom. But you can, these are candlestick charts with volume in green and red designating days that were higher and lower in net price on the close and how much volume was changed hands on those days. You could include open interest if you chose to, or lots of other overlays. So if you're a technical trader and you're looking for a charting service that's free, This is available on our website. It's just a question of which contract you choose to follow. And that might be, as you're watching the open interest in the trading volume, as a contract begins to get close to its expiration date, you might want to roll to the next quarterly contract, either in your position, but also in your analysis if you're looking forward. So there's lots of things you can do with the charting tool. This is the volume and open interest page. Again, this is for the E-mini S&P 500. And what you're seeing for the December contract is the total volume that traded that day, the amount of that volume that traded electronically on Globex. But you'll notice there's some other inputs. Clearport are trades that come in that were more than likely done as block trades. Here's the block trade column here. EFPs refer to exchange for physical trades. These are trades that were done as spreads to possibly ETFs or baskets of cash stocks. Exchange for risk position is another variation of that. And no deliveries, because this isn't a physically delivered contract. And then this is the change in volume on the day. But you can track volume and where it comes from if that's interesting to you. In some products, like physically settled contracts, it could be meaningful to tell you how much was delivered in that day period. We have another suite of tools available called QuikStrike. And these are analytical tools predominantly used around the trading of options on futures. QuikStrike can be found in a lot of places on the website, but a good place to start is under the products landing page, looking at options. And going there, you have a choice of picking different QuikStrike styled tools. If we were to look at pricing, volatility, and strategy tools, for example, you can, and I'm still picking on the E-mini S&P here. This is E-mini S&P for December, which expires on the 15th of December. Pick a strike price for an options expiry, a put or a call. You can change the futures price in this case. How many days are left until expiration? This is just a risk-free rate, and that's a default number. If you want to change that, you can. And then it'll spit out the premium implied by this pricing model, the volatility, what the delta is, the gamma, the vega, and the theta on this various options. For those of you familiar with options theory, and we did have a webinar on that not long ago, this is another way of getting that information on a particular product at a particular price and a particular strike. But there's more to do with QuikStrike. If you click on the open interest toggle, it'll take you to what's known as the open interest heat map. I think this is an invaluable piece of information, very valuable piece of information, because it shows you, again with the E-minis, S&Ps, you've got all of the various expirations of the options on the futures contract, and in this case, this is only a small segment. It's taking you out just a couple of days. It continues on. I had to chop this off because it would have gone all the way off the PowerPoint slide. But what it's giving you is the various expiration dates at the top, and you can see 1 day, 4 day, 5 day, 6 day, 7 day, 8 day. We basically have in the equity index options business daily expirations for the first 5 weeks. And then after that, monthlies and quarterlies. And then looking at those expiration dates that are all based, you'll notice it's all based on the same futures contract price at the top, 43.66 1/4, and then the various strike prices in this column. Puts and or calls and puts left and right, showing you the open interest in those strike prices. Some of them are rather large, some not so large. This is another key piece of information to even a futures trader. Even if you're not an options trader, you might want to be aware of where there are large pockets of option open interest, because as the market moves to that number, you're going to get an increased amount of futures trading as the delta neutral traders are buying and selling futures contracts to stay neutral to price risk. So this is, again, it's an important piece of information. This is available on any of our options products on which we have open interest.
Can I ask you a question?
Yeah.
If there is high open interest, let's say we take gold, okay? Supposing there's high open interest at $2,000 strike price, does that mean that that will act as a support when the prices move up, or does it mean that the market is bullish? What does it mean?
It doesn't mean anything other than it tells you there's a lot of open interest in either the put or the call.
Okay.
Which could mean as the market approaches in the futures price terms, let's say it's February gold,
Yeah.
$2,000 strike price,
Yeah.
and you've got what it would be now considered a very close but out of the money call with a lot of open interest. If I've got a large short call position in that strike price, as the market moves higher, I'm getting more and more risk.
Yes.
The only way to offset that risk would be to buy more futures contracts to neutralize my delta, which is increasing as the market goes higher, and I'm short that delta because I'm short the call.
Okay.
What it would tell me is that that price point, if the open interest is very large, could intensify the futures trading as you approach $2,000. Now, is that bullish or bearish? I would say yes, it's both. It means there's more trading activity. And for every time you bring in a buyer who has to hedge his delta, you're going to bring in somebody who's going to be selling it to him. Whether they're making profitable trades, we're never going to know, because you've always got a buyer and a seller in every futures transaction. But it's another piece of that informational puzzle that is useful to risk traders and risk managers that they might not have had prior to electronic trading. So all of this information only exists because it's available through electronic central limit order books like we operate through our Globex system. If any of you were listening to our webinars that we've done together over the last several months, you probably heard me reference the Commitment of Traders report, which is a piece of information that our federal regulator puts together, the Commodity Futures Trading Commission, and publishes every week on their website. What they're getting from CME Clearing and every other US regulated futures exchange is who holds the open interest in our contracts. And it's a different reporting class, whether it's a financial product or a commodity contract. I'm more familiar with the financial products, but this is an example of the Commitment of Traders data as we lay it out on our website. And it shows you long positions in dealers, asset managers, leverage funds, and others, then the short positions and the spread positions. I'm not fond of the way this is laid out. It's hard for me to understand this, so I do my own. But it shows you, in terms of the open interest positions itself, which reporting class is long or short that week in terms of open interest. Again, it's not giving you the entire picture of the contract, but it's giving you a little more information. It should be said that it's always based on data from the previous week. So it's not live data, it's about a week old. If you go to the data drop-down on the website, and again, this is a CME product called CME Volatility Index. We call it CVOL. This relates to the volatility measures expressed on our options markets for all of our asset classes with the exception of the equity markets. You'll notice, again, I had to cut this off to fit it into the slide so you can see it. But you can see at the top, in interest rate products, which are at the top of the slide, these are expressed not in volatility terms, but in basis point terms. And I don't want to get into a lengthy conversation about how you calculate the value of a basis point, but it's giving you a lower number in the basis point volatility means that the changes in the valuation of that are less. In other words, a lower basis point value represents lower volatility. A higher basis point value represents higher volatility. You can look at the treasuries, 2s, 5s, 10s, and 30s are our most actively traded options on treasuries. And then we've even taken one that calculates them all as an average, and we just call that treasury. I look at the treasury volatility every day, and when the treasury market's volatile like it's been in the last 2 weeks, that number moves around a lot. That might be an indication that there's a lot to do in treasury futures trading.
So does it mean the volatility is it's from the ATR, the average true range?
Sorry?
How does it compare to the ATR, like the average true range of the script?
I don't know what that is, so I don't know how to answer that.
Okay, so let's say, let's take AUD USD. And in the futures, I can see in the last 4 hours or 4 days or 1 day, what was the average movement of that script. So is that how you calculate this?
The CVOL is a calculation of a lot of things. It's designed to capture the next, what would be projected the next 30 days worth of trading volatility. So it takes an array of all the puts and calls, all the strikes, and all of the options that are currently trading.
So
I don't know
how
what
do
the
you take
script
advantage
is.
of this? This is what I'm trying to understand.
I don't know. In commodities, which we'll go to when I go to the live screen, you're seeing the calculated implied volatilities. And then there's also some calculations that we can show in terms of the skew and the changes in the up volatility skew, down volatility skew, lots of things that can be done there. The interest rate products are a little different because they're not quoted in volatility terms, would be my point. This is the beginning of, again, another piece of important information. There might be a trend in volatility in a product, a market that's not trading a lot, either not actively, or the price differences have gotten very small or very narrow. That'll be reflected in a chart pattern, but it might also be reflected in the volatility, which could give you another piece of information. A contract or a product that's trading very heavily but in a narrow range wouldn't change the price pattern on a chart, but it might change the behavior in the volatility index. And then, of course, you've got one that's swinging all over the place, is going to have a wild dispersion on a chart pattern, but would more than likely have a higher volatility profile as well. So none of these tools are going to ever give you the whole story, but they're pieces of that story for you to determine which ones are useful to you and which ones may be useless to you. This is a screenshot of the CVOL for gold. The dotted line is the price of the contract, our standard gold 100-ounce contract in dollars. And you can see moving from the lower left to the far right, moves up, moves sideways, trades down, moves sharply higher because of events in the Middle East in November, earlier this quarter. The solid line is the implied volatility as expressed by the CVOL calculation. It spiked in March. Well, what took place in March? It was the U.S. regional bank crisis. Volatility tapered off, bottomed out down here, and then whoosh. September, concern about interest rates, and then fell off. It's been trading back and forth over the last couple of days. But you can see, the volatility is moving. And depending on what's pushing gold around, is pushing volatility around too, as people are moving in and out of the options markets. The indicators at the top with the lines through them aren't being shown. All you have to do is click on those, and that depiction will show up on the chart as well. I'm particularly fond of the skew ratio, which I'll show you when we go to the live screen. And then lastly in the deck, which we can make available to you as a PDF, these are quick links to some things that you might want to do on your own when you're at home or in your office with your own computer. Courses that are available from our educational portal, CME Institute, from everything from technical analysis and other commentaries on how to build a successful trading plan. This is all to be made available to you as a PDF. You can look at it yourself. So if you don't mind, I'll pause for questions, but if not, I'll toggle to the live screen and we can start to have some fun with the real live pages themselves. Does anybody have any questions at this point?
This, sorry,
Thanks.
the charting factors which you showed, does it have a replay option? Can I go back? and
On the
back
technical chart creation?
Yes.
You can pick whether you want to see, an hourly, a daily. It lets you just decide what type of chart depiction you want to see. And you can actually drag it backwards and forwards if you want to. And in fact, we'll look at that in just a minute.
Is it possible to save the chart, or you have to every time make it? You can save it?
I don't know about whether you can save it or not. That's a good question, but I don't know the answer to that. I've never saved them because I wouldn't know how, but that doesn't mean they couldn't be done. I don't know. Sorry. Anybody else before we move?
I just thought the question from earlier was, is the volatility, do you know, if is it calculated from settlement price to settlement price of a day, or is it what happened
intraday?
in that day?
When we get to CVOL, I'll show you two examples of how you can do. I've always just looked at end of day, but there's also, I believe, a live version that will give you sort of an intraday view as well. Maybe that'll speak to that question. Let me just, bear with me as I toggle back. Okay, is that coming up there? Brilliant. All right. This is what I mean about there's the education tab. Here are the other three. Let's go to charting first. Shall we use gold as an example? Would that be acceptable?
Yeah.
Okay. I've moved to the metals homepage, and I hate doing this without a mouse, but I'll do the best I can. Gold futures. When I click on gold futures, note the spinning wheel. Okay, this takes us to the next landing page. Then if you drag the cursor down, let's look at quotes. Now you can see the various futures contracts. The one with the little suitcase highlighted is showing you the one that's highlighted at the top. It's the December contract, which is currently the one that's most actively traded. Now if I click on this little icon here, that takes me to the charting function, from which I can make that bigger. This is a 1 hour or a 1 minute chart. I can make it a daily chart, or here, I'll just do the drop down again. You can see the choices. So you can make it as depending on what your point of view is, on how much of a screenshot you want to see. And you've already got the volume built in at the bottom. And you can see, I've just got the bar chart here, not the candlestick. I'm going to get a chair, so I'm not leaning on my knee. I dragged that thing over here, but I'm afraid to disconnect it. So you can see the toolbar on the left allows you to draw trend lines, and then across the top, if you go to indicators, you can select all manner of possible technical overlay strategies. So as you're advancing in your trading learning, there may be certain indicators that you like. It might be Bollinger Bands. You'll say, well, what are those? Well, do a Google search on that. You might like moving averages. You might like, oh, wait a minute. I'm particularly fond, personally, whoops, sorry, of relative strength indexes. Down here. There it is. Oh, where the hell did it go? Come on now. This is probably faster anyway. Relative strength index. And it pops up. Now I can see the price action, the volume, and a relative strength measurement. That might be, if that's a technical indicator that you like, you can pull that up. If you want to follow open interest, that can be pulled in as well. This contract is very close to expiring. Its first delivery day is the end of next week. And on the first business day of December, a very large portion of this open interest, what's left, has already rolled forward to February. What's left will probably be delivered on that first business day. So it may be time, if you're tracking gold, as you watch the volume and the open interest, which we'll look at on the settlement drop-down in just a minute, it might be time to be thinking about, if you don't have an open position, tracking the February contract instead of the December, because there's more volume and open interest in it. Or if you've got a position in December and you don't want to face delivery, it's time to roll forward. So that would be information that you'd also find. So that's the charting tool. And you can have all the fun you want with this. If you don't think technical analysis is useful, then don't waste your time with the charts and so forth. But if we go back to the price page, now let's look at the settlements. This is where you see the total gold complex at CME in terms of estimated volume for the day and prior day's open interest. Now, you'll notice the open interest in the December contract still has 203,000 contracts open. That's a large number.
Where's that figure?
Sorry?
Okay.
You see it on the far right.
Yes, yes.
This is giving us, if you look at the 487,533, that's the total open interest in all of the listed contracts.
Okay.
So December still has, maybe not 50%, but about maybe 40, 45% of the open interest. I would suggest to you, now this is current, but within the next 5 to 6 days, this is going to roll down to here. Now you'll still see there's a few November contracts open. They're going to be delivered before month end, and that will fall off and another contract gets listed further out the listing cycle. December rolls up a position, but they can technically be delivered on the first business day of the month. So this volume is going to begin to roll down to here. That open interest will begin to roll down to here, and some of this, it just rolls to stay current. But this is important information for you to be aware of. When do I roll? You want to roll when the bulk of the open interest rolls. But in a physically settled contract like gold, your broker is going to contact you. If you're not prepared to finance a delivery mechanism and get the depository warrant, they're going to make you roll or close out your position. So be advised. Now let's take a look.
Are there any queues here for trading?
Sorry?
Any queues here?
It's just
for traders.
Yeah,
Any information that providing you pointers as to how the price is going to behave.
I think what this gives you is information about where the volume is.
Yeah.
Most of this activity, let's forget February, but moving further out the curve is more commercial.
Yeah.
It's a professional commercial trade. There are certain opportunities within some of these commodity contracts for intra-commodity spreads between these that aren't related to the roll, but that's a technical trade that requires a little bit of insight into the product. The gold curve is currently in contango. You can tell that by the price behavior, or the settlement values in particular, go up as you go out in time. So that's a key piece of information to know. You can see where there's open interest. So if you were in December and you say, I've got a roll, what am I going to roll to? Well, if it's just your own personal trading account, you want to be where the most volume and action is. That's going to be in the one with the next largest open interest. So that's a key piece of information. But if you're a commercial trader trading gold, this may be less relevant than the actual timing of the deferred contract. So I would suggest for self-directed traders, you're going to seek the contract in the next sequential month. Some commodities, it's not necessarily a March, June, Sept like it is in financials. So it depends on the traditional trading pattern and listing pattern of the contract. So for example, December doesn't roll to March like it would in an E-mini S&P. It rolls from December to February in gold. And you'd be able to determine that by looking at the settlement page where the open interest is sitting. Let's look at, just to give you an indication of how this works, if we go back to quotes, and now we look at, come down here, sweetheart, let's go down to December again, just for illustrative purposes, and click on Options. Now you're going to see a slightly different screen of, and I'll scroll down in just a second. You're seeing the strike prices based on the underlying futures December gold contract, and then you plug in the options expiration that might be relevant to this, and there could be more than one in this drop-down menu. There won't be, because this is going to expire in a week, so there's only a December options about ready to go roll off. But when we look, if we were to put in February gold, and I will, you're going to get a choice of multiple option expirations. And then for each one of those you click on, you'll get the pricing page with all the strikes, puts and calls, and possible bid and offers and last changes. It's not going to populate like a broker spreadsheet because this isn't necessarily a live market. But let's look at, if we go to Feb Gold, now we have our choice of multiple expirations. Now you can pick a January option that prices to the February gold price, and then look at the various strikes. Now let's just look back up here. Feb Gold is trading last at just short of $2,010. So a 2010 is going to be the at the money strike price. That's highlighted here, and you can see a relative, at least you get a representation here of the prior settlement in the premium versus the last traded premium price. Calls on the left, puts on the right. This might be useful as a starting point to do your options analysis. Now, if you've got an options calculator or your broker provides you with some sort of an options overlay, you're going to be able to get those possibly in real time. That could be useful. But another useful feature while we're on this page is to now when you hit calendar, you're going to see the options expirations. So the January option that's pricing to the February futures contract has a last trading date of the 26th of December and a settlement of the 26th of December. So it's called a January option, but it expires in the month of December. That is very important information. Now, why would an option on one of our contracts with a monthly identifier not expire in its calendar month? In the case of a physically settled futures contract, in order for there to be something for the option to exercise into, in this case a February futures contract, there has to be open interest in the February futures contract itself. And because this is priced against a February futures contract, that can be delivered the first business day of February. So the option has to expire well in advance of the underlying futures position. So again, there's a lot of information that could be available and useful here. What else would you like to see with respect, is there anything else in here that would be of interest to any of you? I mentioned, the contract specifications are in here. This shows you what the contract is really based on. Gives you lots of information about when it stops trading. It is deliverable. Here's some more of those QuikStrike tools down here. And then I mentioned margins. If you're looking at, want to know what the official margins are. They're quoted in maintenance margin terms. Initial margin is going to be roughly 110% of that. But then again, check with your friends at APM about what the margin is, because they're going to be representing you on the brokerage side. There might be an interest in trading gold versus silver as a spread. If you're interested in that type of relative value trade, you might want to know if there's a margin offset on an inter-commodity spread. Where are we? Gold versus silver on a one-to-one basis can result in a 70% margin offset on a long-short spread position. If those of you as traders are interested in relative value trades, which is selling one commodity and buying another simultaneously, if they're highly correlated, like gold and silver are, you have the opportunity to enjoy an additional margin offset, because instead of the outright risk, clearing looks at a spread position like that in net risk terms, and in this case, there's a resulting margin relief on that net position. I think that's very important if you like spread trading. Let's see. Let's go back to CVOL. Now that's under data. If we go to data and we go to CVOL, it sometimes takes a few minutes for this to pop up. Now dashboard, and don't hold me to this, but I'll check if you're interested in following up with me. I believe this is intraday. It's taking information as it's reported by what we see in clearing, where I tend to toggle over to end of day. And now let's look at gold as an example. I click on the little charting icon to the left of the word gold, and this is what pops up. Again, the dotted line is showing you the price. It's roughly $2,000 per contract at the moment, or per ounce. The volatility is in the solid line, and I mentioned we can look at the skew, or if you're interested in the skew in terms of calls versus puts, I think this can be a useful piece of information. All it's taking into account are the total number of puts and calls that trade. If you're familiar with options theory, you're familiar with what's known as the options smile or the skew. In most cases, they call it a smile because it looks like this at the money, and puts and calls, their volatility goes up as you move away in and out the money. Not all products have a smile as a skew. Some of them are smirks. Some, they don't get frowny, they don't get negative, but they do smooth out depending on the products. This is giving us a number. In this case, here as I highlight it, you'll see the number on the far right. You can see the futures price, $210.20 per ounce. The CVOL index is at 1192, and the skew ratio 1.15 suggests the skew is higher in calls than it is in puts. If it's less than 1, it's higher in puts than it is in calls, and if it's right at 1, it's a balanced skew ratio. This would suggest, it could suggest several things, and I'm not going to imply that there's one specific answer, but it tells me that volatility is very low in relative terms in gold. The price has moved up recently, and the volatility as measured, or the skew ratio, is more skewed to calls and puts. Might be more call buying as a result of the movement higher. It could be another piece of information. And again, this is, you got to do your own homework on this to figure out what it is, how this works into your plan. But you can look at the skew itself. If I click on this again, it puts that line back through it. or if you're just interested in the underlying versus volatility, that in itself can be useful. This is available on all of our products where we have options with the exception of the equity market. You know, if you go into WTI crude oil, price recently fell, looks like it's kicked back up a little bit, but you can see big swings in the volatility. This could again provide some useful information. But this is all free on the website. And then I mentioned the QuikStrike heat map tool. Come on now. There we go. If we go back to markets, and this time we go to options. Volume and open interest tools. Here's my friend the heat map. You simply pick the product you want. While we're talking about it, let's pick on gold. That looks pretty good. Okay. Let's put this up here in the center. This thing disappears. Come on. I want this thing to go away. There. So go here. Let's move down a little bit. You can see the various. You can click on the various expirations. This is all pricing against the December in the first month, but then the February contract strike prices. Notice the futures contract changing price, 2010-60. January expirations, Febs, Marches, Aprils, Mays, all pricing against these two, pricing against February. This is pricing against March. Or excuse me, April, and you can see the pockets of open interest that remain. Could be useful information based on the strikes. You know, you can see here under calls, 9,300 at the money, or just out of the money, in the money, $2,000 calls for December expiration, 6 days left to trade. That could be meaningful. The futures price in the December contracts is still below 2,000, so they're just slightly out of the money. Could be interesting if gold goes higher to see what this open interest does to futures trading as the December contract gets to near $2,000 a contract. This is also, you can see this, and depending on the products trading in options, obviously the numbers go up if it's a heavily traded contract. They go down if it's either a new options listing or a relatively lightly traded options product. That would also be intelligence you could gather from the heat map. So that if you didn't feel there was significant open interest in the options, maybe you would prefer to avoid them. That kind of thing. Sometimes the best trading decision you can make is not to make a trade. And that's part of the decision-making tree. Is there anything else that any of you would care to see or explore on the website? It all starts at cmegroup.com.
Is the volume data, is it live or is it with a lag?
I think most of the information is delayed.
Delay.
Yeah.
How much delay?
I guess I think it's 10 minutes on the quote page. And depending on your brokerage firm, obviously you get live quotes.
No, but is it possible, along with the price movement, for live volume data to be given, or it's not really possible, you know?
Oh, you can see the live volume. You're not going to see the change in open interest until the end of the day.
Okay.
Open interest is always reported from the previous day's transactions because it's based on settlement value
Right.
and settlement number.
Yeah.
But you can see the intraday volume as it's been reported through the central limit order book, at least, from the clearinghouse.
But is
So-
the volume updated, let's say, with the price every second or whatever?
I think, again, if it's on our quote page, the volume you're seeing is related to that 10-minute delay.
Oh, it's okay. Cool.
I think that's my understanding. You know, if you're looking for live data, that's going to have to come through a broker.
Like MT4, the MT4 gives now the volume data given by MT4, is that live or is that also with the lag?
Well, like I said, anything that's free on the website is going to have a time delay.
Oh, I see. Okay.
None of this isn't a live trading platform.
Yeah.
It's basically an informational platform, so it's delayed data. Nobody wants to trade futures on a 10-minute delay. That would be idiotic.
Absolutely.
So it's on your execution platform that you're dealing with live prices, live volume, live information. Anything less than live is dead. It's useless. You've got to know what the current market is. So, but this gives you some insights into things that are available to move you hopefully a little bit forward in your learning curve without putting you at risk. You can learn and kind of begin to develop your own skill sets at your own pace. And there's help along the way. The education tab that takes you to CME Institute, we have lots of courses and tutorials. All of the products and things that I've highlighted have their own tutorials on them. In many cases, a lot more descriptive than I'm even giving you today. So if you're interested, take the time to do your own learning, do your own homework by using the education tab to get further into our products and services. And then when you have questions, if you don't get the answers from the website, feel free to contact CME Institute. And myself or one of our colleagues on the education team will respond. And if we don't have the information directly, we can go to our business line partners and salespeople to get the information back to you. And then, of course, you've always got your broker as another source of maybe the operational side of your trading account, which is also key and vital to know before you start to trade. So all of these things are meant to be educational and informative. I hope it's been useful as far as an information transfer. If I can answer any other questions, I'm happy to, but I think, Mark, we've...
Yeah, I was just going to say, if you've got any kind of conclusions or...
I think that's it. It's a big marketplace. It's a global marketplace. It's a 24-hour-a-day trading marketplace, 5 business days out of the week. You know, I can't stress enough that as you begin your trading, take responsibility for your behavior. You know, own the fact that you've got to learn. You walk before you run. Take your time. And as you get questions, ask them. But in the end, you're going to learn by doing. So be patient with yourself, limit your losses, and take advantage of all the free tools you can get. And as you become more skilled, you'll begin to develop your own trading style. So with that, I wish you the very best of luck. And I will hang around and answer any questions I can, either collectively or individually, because we've got some social time to engage in together. So on behalf of CME Group, thank you for coming. Thank you for your interest.
Well, I enjoyed that. I hope you all did too. Some of the learning tools are available on the APM Capital website as well, so we're pleased to be able to share that. We are always here to help to answer any questions that you have regarding that. A few of the things which we discussed in some of the webinars leading up to this were some of the products which the CME have launched, which are growing in popularity. As David mentioned today, some of these shorter dated options, you can have an expiry next Wednesday or expiry next Friday. this flexibility, trading slightly in the shorter term, is definitely appealed to a lot of our clients. Another thing which the CME have brought out more recently are micro futures, a smaller exposure but a smaller margin as well. Again, just gives you a bit more flexibility with your portfolio, allows you to diversify, so gold and oil and indices with the same amount of investment as before. But anyway, I'd like to thank you all very much for coming. Please, there's refreshments outside, and stay tuned. We'll hopefully be doing another one of these next year. Thanks very much.